Dealer says some coin shops might not survive $100 silver. Here's why. Silver just crossed $95 an ounce. A phone call came through on Wednesday afternoon. One of America's largest refineries. Changed everything. In minutes, coin shop owners across the country suddenly found themselves trapped, holding metal they cannot sell. With no way out, some will not survive what comes next. And if silver hits $100 this week, the flood begins. Well, hello there, friends. Welcome to Boring Currency Registry. Now, before we go any further into this rather serious situation unfolding in the silver market, may I ask you a small favor? You see, if you've made it this far in life, perhaps you're someone who appreciates straight talk about money, markets, and the real mechanics of how things work. No fluff, no games, just the facts laid bare. If that sounds like you, would you mind clicking that subscribe button down below? Think of it as pulling up a chair to a table where serious people discuss serious matters. We'd be honored to have you join us regularly. And one more thing, if you don't mind, drop a comment and let us know where in the world you're watching this from today. Are you in Texas, California, perhaps somewhere overseas? We're curious to know where our community of thoughtful viewers calls home. Now then, let's get into what's really happening with silver right now, and why some businesses won't make it through. Silver is behaving in ways that veteran dealers have rarely witnessed. As cameras rolled for this conversation, the price sat at $95.18 per ounce. Not 94, not 90, 95. And it showed no signs of slowing down. For context, silver began this decade trading in the low 20s. It spent years moving slowly, predictably, within ranges that dealers understood. They built their businesses around those ranges. They knew how to buy. They knew how to sell. They knew their margins. That world no longer exists. Josh operates a coin and bullion shop in Minot, North Dakota. He has been in this business long enough to remember 2011. When silver last made a dramatic run. Back then, it climbed to nearly $50 an ounce before collapsing. Many people lost money. Many dealers struggled. Some closed their doors. But Josh says this time feels different. It is not just the speed. It is the behavior. It is what is happening behind the counter, in the back rooms, in the phone calls between dealers and their suppliers. Walk into Josh's shop on any given day this past week, and the scene would have been unusual. People were coming in, but not to buy. They were coming to sell. Not a few people, many people. Silver bars, silver rounds, American silver eagles, Canadian maple leafs, bags of old coins. They arrived carrying metal they had purchased years ago, perhaps at $25 an ounce, perhaps at $30. Now silver was pushing toward $100 and they wanted to cash out. This would normally be good for business. Buy low from the public, sell high to other customers, keep the spread. That is how coin shops have always operated. But something changed. Josh was buying so much silver so fast that his shop began to fill up. His inventory swelled. His cash reserves started to shrink. He was paying out tens of thousands of dollars every day to sellers, and the metal just kept coming. Meanwhile, his retail customers, the ones who normally buy silver, were still there. They were still purchasing. But they could not keep up with the tidal wave of incoming supply. Josh found himself in a position he had never experienced before. He was drowning in silver, and he needed a way to convert that silver back into cash so he could keep his business running. Under normal circumstances, this is not a problem. Dealers have relationships with wholesalers and refineries. When inventory builds up, they ship it out. The wholesaler or refinery buys it. The dealer gets cash back. The cycle continues. That system has worked for decades, but in the middle of last week, something broke. Josh was operating under the assumption that he could move excess inventory whenever needed. He was paying sellers $5 below spot price for silver rounds. He was paying $4 below spot for government-issued coins like eagles and maple leafs. These were fair prices, competitive prices, prices that allowed him to stay in business while still giving sellers a good deal. But those prices were based on one critical assumption. Josh assumed he could sell that same silver to his wholesaler or refinery for perhaps $2 or $3 below spot. That would leave him with a small profit margin, enough to keep the lights on, enough to pay his bills. On Wednesday afternoon, his phone rang. It was his main wholesaler. The tone of the call was urgent. The message was brief. One of the largest refineries in the United States had just released a new price sheet. The refinery would now pay dealers $15 below spot for silver. $15. Not 2, not 3, 15. Josh had been buying silver all morning at $5 back. He had inventory sitting in his shop that he purchased at $5 back. And now, if he needed to liquidate it, he would lose $10 per ounce. He did not have time to process the implications. There were 4 customers waiting in his shop to sell silver. He had already quoted them prices. He honored those quotes. But after those 4 customers left, Josh pulled down his price signs. Everything had just changed. The traditional exit door for coin dealers, the door they had always relied on, had just slammed shut, and if that door stayed closed, some of them would not survive. Josh was on top of the world. As a precious metals dealer, he'd built a thriving business from the ground up. Gold prices were soaring, and his clients were thrilled. He felt invincible, like everything he touched turned to, well, gold. Then, one Tuesday morning, everything changed. News alerts screamed across his screens. A sudden, unexpected market crash sent precious metal prices into a free fall. Panic set in. His phone started ringing off the hook with frantic clients demanding answers he didn't have. Years of hard work, trust, and financial stability were evaporating in minutes. This wasn't just a market dip, it was a full-blown crisis, and Josh was at the epicenter. Could he navigate the storm and save his business, or would he lose everything? Find out what happens next in our series. Subscribe so you don't miss it. Josh had a decision to make, and he had minutes to make it. He could continue buying at his posted rates and hope that retail sales would be strong enough to move the inventory. But if a market correction came, if silver dropped $10 or $20 per ounce in the next few days, he would be ruined. Or he could adjust his buy prices immediately, protect his business, protect his capital, and risk alienating the customers who had supported him for years. There were 4 people in the shop at that moment. They had silver to sell. Josh had already quoted them prices based on his posted rates. He honored those quotes. He bought their silver at the old prices. It was the right thing to do. They had come in good faith. They deserved to be treated fairly. But as soon as those 4 customers left, Josh turned to his assistant. Take down the signs. We're changing our prices. Right now. The new buy price was $10 below spot for all 999 pure silver, $10 below spot for rounds, $10 below spot for bars, $10 below spot for everything. Josh did not arrive at this number arbitrarily. He calculated it based on cold economic reality. If the refinery was paying $15 below spot, and Josh needed at least a $5 buffer to cover his costs and risks, then he could pay no more than $10 below spot. It was not a decision he wanted to make. It was a decision he had to make, and he was not alone. Across the country, other dealers were receiving the same information. Some adjusted quickly, some were slower to react, some did not understand what was happening until it was too late, but the shockwave was spreading. 2 days after the initial price sheet was released, the refinery sent another message. They were no longer buying alloy silver at all, no 90% silver coins, no 40% Kennedy half dollars, no sterling silver, no 80% Canadian silver, nothing. If it was not 999 pure, the refinery would not touch it. This was unprecedented. Refineries exist to process precious metals. That is their entire business model. They melt down old jewelry, coins, bars, and industrial scrap. They separate the silver from other metals. They produce pure silver ingots that can be sold into industrial and investment markets. For a refinery to refuse an entire category of material means one of 2 things. Either they are so overwhelmed with incoming supply that they physically cannot process it fast enough, or they believe the market is about to turn, and they do not want to be caught holding inventory purchased at peak prices. Likely, it was both. Josh sat in his shop that evening after closing. The lights were off, the door was locked, and he stared at the rows of silver bars and rounds stacked on his shelves. He had always believed that silver was liquid, that it could be converted to cash whenever needed, that there was always a buyer. But now he understood something he had not fully grasped before. Liquidity is not a feature of an asset. Liquidity is a function of market structure. And that structure was collapsing. The phone would ring again tomorrow. More customers would arrive. More silver would come through the door, and Josh would have to look them in the eye and explain why he could only pay $10 below spot. Some would understand. Some would not. But one thing was certain. If silver hit $100 an ounce, the flood would begin, and no one knew if the market could survive it. There's a question that seems simple on the surface. What is silver worth? Most people would answer by checking the spot price. They would pull out their phone, open a financial website, and read the number displayed on the screen. $95, $96, whatever the futures market says at that particular moment. But in the 3rd week of January 2025, that number stopped meaning what it used to mean. Because across different parts of the world, and even across different parts of the same country, silver was trading at wildly different prices, and nobody could agree anymore on what the metal was actually worth. In Shanghai, China, physical silver was changing hands at $107 per ounce, perhaps $108. Reports varied, but the range was consistent. Chinese buyers were paying $10 to $12 more than the spot price quoted on Western exchanges. Some analysts suggested this premium existed because of a value-added tax applied to precious metals in China. Others argued it reflected genuine supply shortages in Asian physical markets. The exact reason did not matter as much as the result. Physical silver in China was commanding a significant premium over paper silver prices in New York and London. Meanwhile, back in the United States, a completely different reality was unfolding. Josh was not just buying silver at $10 below spot. He was selling it below spot as well. Walk into his shop with cash in hand and you could buy silver rounds for $2 or $3, less than the spot price. American Silver Eagles might be at spot or just slightly above. But the days of paying $5 or $6 premiums were gone. Why would a dealer sell below spot? Because he had no choice. Josh's shelves were full, his safe was full, his back room was full. He had purchased thousands of ounces over the past 2 weeks, and retail demand could not absorb it fast enough. He needed cash. He needed liquidity. And the only way to generate that liquidity was to offer prices so attractive that buyers could not resist. So he ran sales. $2 below spot, $3 below spot, sometimes more. And even at those prices, he still could not move inventory fast enough. Think about what this means. In one part of the world, buyers were paying $107 for an ounce of silver. In another part of the world, buyers were paying $92 for the exact same ounce of silver. That is a $15 spread on a commodity in a globally connected market in the age of instant communication and electronic trading. This should not be possible. Under normal conditions, arbitrage traders would immediately exploit such a gap. They would buy silver in the United States at $92, ship it to China, and sell it for $107. The price difference would narrow within days as supply flowed toward the higher-priced market. But that was not happening. Something was seriously broken in the plumbing of the global silver market. While some dealers were overwhelmed with supply, offering silver below the spot price just to get cash, others were experiencing the exact opposite. On the West Coast, shops couldn't keep silver on the shelves. Customers were lining up and dealers charged huge premiums. So at the same time, in the same country, two completely different silver markets existed. This isn't how efficient markets work. It raised a terrifying question. If you needed to sell your silver, what price would you actually get? The spot price was just a number on a screen. The real price depended entirely on who you could find to buy it and how quickly you needed the money. In other words, silver was becoming illiquid. The cracks were showing and things were about to get much worse. Thanks for watching. The CoinShop business model isn't complicated. You buy from the public at a small discount to the spot price, and you sell to the public at a small premium over the spot price. That difference is your profit. You use that profit to pay for rent, utilities, employees, insurance, taxes, everything needed to run a business. It's a straightforward model that has worked for generations. But it only works under one critical condition. The dealer must be able to convert inventory back into cash when needed. This conversion mechanism, the ability to sell excess inventory to wholesalers or refineries, is what makes the entire business model viable. It's the foundation. Without it, the whole structure collapses. And right now, that foundation is crumbling. Josh sat in his shop on a Friday evening. The week had been exhausting. He'd processed more transactions in 5 days than he normally handled in 2 weeks. His back hurt from lifting boxes of silver. His voice was hoarse from explaining the same situation over and over to confused customers. But more than just physical exhaustion, he felt something else, uncertainty. He didn't know if his business would survive the next 60 days, and he wasn't alone in that feeling. Throughout the week, Josh had spoken with other dealers. Some were in even worse positions than he was. They had bought more aggressively, had larger inventories, and had less cash in reserve. They were starting to panic. One dealer in a neighboring state had already announced he was closing his doors temporarily. Not forever, just until the market stabilized, until he could figure out what to do with the mountain of silver sitting in his vault. Another dealer had simply stopped answering his phone. Josh didn't know if that meant the business had failed or if the owner was just too overwhelmed to communicate. The stress was breaking people, and the psychological trigger point hadn't even arrived yet. Silver was at $95 an ounce. It had briefly touched $96 earlier in the day before pulling back, but $100 was coming. Everyone could feel it. And when it arrived, the selling pressure would intensify. Josh knew this because his customers had told him directly, explicitly, "I'm waiting for 100. When it hits triple digits, I'm out. 100 is my exit price." He'd heard variations of this at least a dozen times in the past week. These weren't traders or speculators trying to time the market perfectly. They were ordinary people who had bought silver 5, 10, 15 years ago. They had held on through all the ups and downs. They had been patient, and now they were about to get their reward. Or so they thought, because what they didn't understand, what most people outside the industry don't get, is that their ability to sell depends entirely on someone being willing and able to buy. And the number of willing and able buyers was shrinking rapidly. Josh ran the numbers in his head. If spot silver hit $100 and he kept his current buy price of $10 below spot, he'd be paying customers $90 per ounce. That's a fair price under current market conditions, but it assumes he could do something with that silver after he bought it. If retail demand stayed steady, he could sell most of it across the counter, maybe at spot, maybe slightly below, and make a small profit, enough to justify the risk. But what if retail demand dried up? What if buyers decided to wait for a correction? What if the psychology shifted from greed to fear? Then Josh would be stuck holding inventory he bought at $90 an ounce with no exit strategy. And if the spot price then dropped to 80 or 70 or 60, he would be financially destroyed. This wasn't a theory. This was the exact scenario that had wiped out coin shops in 2011. Back then, silver had climbed to nearly $50 an ounce. Dealers had been buying aggressively, and inventory was piling up. And then the correction came. Sharp, fast, and brutal. Within weeks, silver had dropped to $35. Within months, it was below $30. Dealers who had purchased inventory at $45 suddenly found themselves sitting on massive losses. Some survived, others didn't. The shops that failed weren't run by stupid or reckless people. They were run by ordinary business owners who made reasonable decisions based on the information they had, but the market moved faster than they could react, and their capital evaporated. Josh did not want to become another cautionary tale, so he made a decision. Starting Monday, he would reduce his buy prices again. Not because he wanted to, but because he had to. $11 below spot, maybe $12. It wasn't a decision he was proud of, but it was a decision that might just keep his business alive. And right now, survival was the only thing that mattered. Because if he survived, if his shop made it through this volatility, he would still be there when the market stabilized. He would still be serving his community, providing a valuable service. But if he failed, if he ran out of cash and couldn't meet his obligations, then another coin shop would disappear from the American landscape. And the infrastructure that supports the physical precious metals market would become just a little bit weaker. Josh wasn't the only one thinking this way. Across the country, other dealers were making similar calculations. Some would stop buying entirely. Some would drastically reduce their buy prices. Some would try to ride it out and hope for the best. But all of them understood the same fundamental truth. Not everyone was going to make it. Thanks for watching. If you found this story insightful, be sure to like and subscribe for more content about the real world of precious metals. See you next time. Hey everyone, ever wonder what it's really like to be a precious metals dealer? It's not just about shiny gold bars and silver coins. The market is wild right now, and dealers are facing some huge challenges. For years, the formula was simple: buy low, sell high. But things have changed dramatically. Dealers are now getting flooded with inventory as people cash in. But finding new buyers is getting tougher and tougher. It's a high-stakes balancing act. They have to manage massive amounts of capital, predict market swings, and navigate a landscape where the old rules just don't apply anymore. It's a fascinating look into a world of risk, strategy, and resilience. What do you think the future holds for precious metals? Let me know in the comments below, and don't forget to subscribe for more deep dives. Thanks for watching.